Is how we left off at, and of course the Sensex was up 300. What do we have? The quarter percent on the Nifty, 25,060 or so, almost a quarter there. The Nifty Bank is up a third, so 51,180 on the Nifty Bank. Sensex is starting about a quarter percent higher, and you've got the mid-cap index, which is up about 0.6%. What was heartening, of course, yesterday was that broader markets also picked up nicely. So, you know, that is always good. We've got IT index, which is starting a third of a percent higher, just taking note of it because we've got TCS earnings tomorrow, and that will kick off the second quarter earnings season. Heat map on the Nifty, just to quick snapshot view of how many are up and how many are down. It's 35 odd stocks which are higher, and I mean, you know, the rest which are starting the day lower. But 50 closing on 50-point gain, just in terms of the start that we have on our hands. Surbhi.
Okay, let's talk about the movers and shakers on the way up. BPCL seeing a relief rally because of the fall in oil prices. Tata Motors is up about 1.5%. Shriram Finance, Asian Paints. Then you have some bank names up and about. SBI and Axis Bank are the early movers, 1% up over there. ICICI Bank is managing about 0.5%. There's Wipro, there's Power Grid, and then it just starts getting quiet. Trent, yesterday's big star, actually had a bit of green on it. It's still managing about a 1% move. So building on yesterday's momentum, that's Trent for you. On the downside, ONGC, there is JSW Steel, there is Hindalco, so basically Coal India as well. Commodities continue to cool off with uncertainty continuing on China. And then there's the FMCG space, so Nestle, Britannia, these are some of the names on the way down. Bajaj Auto, Eicher Motors also losing ground. So these are the very early trends. Nifty up about 50 odd points, and banks seem to be at least stable for the time being.
Well, that's right. The big mover today is Torrent Power. Just take a look at that stock fly. They've got an LOA from MSEDCL for 2 gigawatt of pumped storage, hydro storage projects. So that one is the big mover, massive volumes on that front as well. And the cruise sensitives are doing well. So you have HPCL, that one is flying away. Interglobe Aviation is up close to around 2%. Where it said that could be the stock to watch because yesterday's close as well was very, very good. But the 20 DMA is at around 4,800 rupees. So you'll have to see whether or not it can get past that. Ashok Leyland, well, it's reacting to Nimesh's standard brokerage call out there. So that stock is a little under the weather. Paytm is pulling back after the surge we saw in the final hour of trade yesterday. And in terms of other big movers, Bajaj Housing Finance, it's come back. It's up 15% in 2 sessions. So good move on that one as well. Suzlon as well is buzzing in today's trading session. That's because of an article which is suggesting that Tata Power, well, they're looking to place orders of around 35,000 crores for supply of wind power turbines. So the street maybe is trying to factor in that maybe Suzlon could be one of the potential candidates out there. We'll have to confirm with the management on that front. But for the time being, one of the top volume movers is Suzlon. So just highlighting that stock. A good start, 50 points higher. We are holding above the 50 DMA. The bulls will want to hear a dovish RBI Governor and then build on from here on. Well,
Absolutely. You know, Bajaj Housing Finance, and basically, I think the stock when it listed, the first rate was about 150 bucks. And from the recent high, it had fallen to that level. And yesterday was up 10%. Was, I think, limit up for the day. It's up another 3.5%. And it is the biggest volume-led gainer right now on the NSE. So look at that. 9 million shares already with just a few minutes behind us now. Reliance Power is up 5%, so it's back to winning ways. So it basically has had a tremendous rally, bit of a correction from the recent high, which was about 52, 53, but back at about 48 plus now. Divi's is, I think we did mention Divi's, 4.5% higher on Divi's Laboratories. So that's another large gainer coming through. Look at HPCL. HPCL is up about 4.5%, and stocks at 408 now. And it's never won, right? I look at IOC and BPCL as well. After that drop about 4.5-5% last night in oil. So IOC is up about 2%, and I think BP also will come up on your screen. We did highlight Torrent Power. It's building on gain 6% on Torrent Power, 1920 or so coming through. What else? IRB and Inox Wind and Senco. Yeah, you got a lot happening. But go down the list, volumes start to thin away a little bit. Maybe they will pick up as the day goes by.
There's Ashok Leyland, Prashant. I mean, markets taking note of that CLSA call. Remember, CLSA has come out with a really bearish report. They're saying that this weakness in the CV cycle, it's been a non-starter, right? Month after month, We look at those CV numbers and they're not picking up for actually any of the manufacturers, Ashok Leyland included. And their call is 188 on the stock. Stock's 217 right now, and big volumes on the counter as well.
Absolutely. I mean, the high was 260, 265 actually or so for Ashok Leyland in 27th of August 2024. So from those levels, it's already come off quite a bit. And of course, now you got this report as coming in as well, and they're calling 188, as would be said in terms of price target. So we'll see. Paytm is the big one. We were talking about this after the sharp surge. It's the biggest volume-led loser right now. 731, about 3% lower. 15% surge yesterday. I just kept pushing higher and higher all day. What else? Ola Electric, lots of interest around this one. In the market and social media, etc. as well. 1.25% lower on Ola. 94. Yesterday, of course, by the end of it was up 5%. Ola Electric.
And one more I'll add to the tally, and that's RITES. RITES is surging 5%, decent volumes as well, because they're getting into the UAE market. They have an agreement with the Etihad Rail to set up railway infrastructure over there. And I guess the market's getting excited about whether this is a brand new big opportunity opening up in all of Middle East, etc., etc. So that news has really energized the counter, 6% up on RITES.
I think, 6%. So it's 317, 318 now on RITES. So lots happening, lots moving. Market holding with about a 50-odd point gain. Devina Mehra is with us. She's a market master of the day, founder, chairperson, and managing director at First Global. Devina, good to have you with us here. Thank you very much. So, simple question. Did the low that we saw yesterday, is that like a major bottom, or is it a temporary one in your opinion? And of course, I mean, some of the events recently.
I would think it's a temporary bottom.
Okay. Go on. Sorry.
There could be a pullback from here, but then there could be a further correction also. So, I mean, if you go back to what I've been saying for the last few months, we had been expecting some sort of correction, but I do not foresee a kind of sustained crash, at least on the large cap and mainstream indices spaces. And as of now, our systems are showing that the small and mid caps would tend to be a little weaker than the large caps.
So what's the roadmap from here? Very hard to predict near term what happens, but in the broader framework, maybe a bit of pullback on the higher side, and then a revisit back to where we were yesterday, and maybe even a little lower. Is that what you're calling for?
That's the likely scenario, though, as you said, in the short term, it's very difficult to predict. And we have been little cautious for the last 6 months. So it's not as if, I'm saying this just now, as right from March, we were hedged. We were hedged going into the election results. We are still partly hedged. But of course, a lot of those strike prices are further away because the market has actually done very well in the last 6 months overall. I mean, there were periods of volatility, but eventually it did well, and which is the reason we never made a cash call. So while we did buy hedges off and on, we never made a cash call because we were clear that there is not going to be a sustained crash. It is just that you have to be in the right pocket. So we moved away, for example, from the very small caps, the 1 to 5,000 crore market cap band. We moved away a lot more than, normally we have like 13-15% there. We went down to 5-6%. So those are the changes we made, but we never felt that there was any need to go into cash because there's always a risk of missing out an up move if you are in cash. And as we've seen in the last 6 months, we have seen that up move. So, if we had acted on that caution by going into cash, that would not have been a good call.
Hi, Devina. Good morning. Always good to see you. Devina, I recall when you got the timing of Tata Motors correct. I'm not sure whether or not you'll have exposure right now, but we have another big IPO that's coming in, the Hyundai IPO. And from a market perspective, a lot of liquidity could go in there. But what's your view on this particular IPO? Because it's going to be coming not at a very cheap multiple. We already have some peers that are trading at a bit of a discount. Your approach to it?
We normally do not either apply for IPOs or, for that matter, buy just after listing. I think there's always plenty of time to do a proper analysis and get in when we need to. So, I mean, I don't particularly have a view directly on the IPO as of now. And while we are overweight on autos, it is not so much the manufacturers, it is mostly the component manufacturers where we have more exposure. So that's where we are positioned. Now, of course, we are in the middle, in another 7-10 days, we would have done a rebalance, a quarterly rebalance. So we'd have a clearer picture of what our systems are saying right now. But this is where we are currently.
Give us some names, auto ancillary, what do you all have?
We have a range of auto ancillaries. So that's the I mean, we do have we do have two-wheelers, we do have four-wheelers, but I'm saying the skew is a little more towards the ancillaries.
Oh, okay. Devina, hi, morning. Great to have you on the program. So I want to ask you a very simple question because there's so much moving in the world, right? From wars to which central bank is cutting, which one is hiking. But for once, and let me add a caveat for this question. The caveat is nothing very dramatic happens. There's no US recession. There is no big, breakout of war in the Middle East. Everything remains status quo. If you were to design a brand new portfolio today from scratch, allocating fresh money, how would you do it and what all would go into it? I know you like pharma, you mentioned some auto, but a brand new portfolio starting today.
We always look at it as a brand new portfolio, Surabhi. That's the philosophy, that every quarter we look at from scratch what looks the best now. Because otherwise, if you start from your existing portfolio, there's something called an endowment bias, that you will value something more simply because you hold it, and it holds for very simple things. Even a coffee mug you will value more if you are holding it, if you have it, rather than when you don't have it. So that's very clear. I mean, I say the only reason a hold rating exists in the world is endowment bias, because anything you will not buy today, you should not hold. It is very simple.
I agree, Devina. And that endowment bias, for instance, like if you have Trent in the portfolio, the world looks like a good place. If you're still riding, the PSU rally, and if you made like 4x, 5x on a HAL, you have a very different perspective on the world, right? That's why I asked if someone has to make a fresh portfolio today.
That's why you need a system to remove that kind of bias, that human element from this kind of analysis. So that's why we say, like, our first cut is what the machine says. And it works both ways. I mean, in 2021, no one wanted to look at capital goods and industrial machinery because that had been a disaster sector for 12 years. And the human fund managers did not look at it for another 2 years. Whereas we went overweight in October 2021 because that's what our systems showed, and our checks showed that yes, this industry will do well. So you forget about the fact that it was a dog for 12 years and now it's going to do well. So we were overweight all this while. Now we are, of course, close to market weight, just slightly overweight. Where we are still considerably overweight also are pharma, IT. So cap goods, as I said, is now close to market weight. So, pharma and IT would be where we are overweight, and auto components I already mentioned. So those would be the pockets as a pattern. We are looking at FMCG. I can't say that, we are not overweight yet, and we've not made a final call, but I think the crude prices going down and likely food prices also going down means that FMCG two factors actually improve, because for one thing, their input costs are like things like oil and also the crude downstream. So that goes down. And also if food prices go down, then in the household budget, there will be more room for FMCG, because right now the food inflation has been meant that food has crowded out the FMCG volumes. So those are things we are looking at. But as I said, as of now, we will be overweight auto components, pharma, IT, slightly overweight cap goods. So that would be, and now last rebalance, while we may not be exactly overweight, but we've added chemical stocks after 2 years. So that was one thing which we added in the last rebalance.
Got it. Devina, we've got a mega IPO, right? The Hyundai IPO, which is here. I remember long back, maybe in the early 2000s, you had written a report on cross-country comparisons and why they don't make much sense. And I remember this example, maybe, I don't remember exactly when, but it was one of those very, very well-written notes, and I hope you do more of that, and maybe put some of those older reports online, because they're
some of them, some of them I have. This was like a story of cross-country comparison.
My question, Devina, is a lot of commentary that maybe Hyundai in Korea trades at 5 PE. Why should it trade at whatever, 30, 40 times it is coming to the market here. You can make that same kind of argument for a lot of stocks, a lot of companies. But just your thoughts around this one for you viewers in terms of an actionable way. Go on.
So, I mean, IPOs, I mean, I'm not, see, IPO, the problem in India in the current scenario is this, that you either will get stocks which don't make sense if you go into the fundamentals, or stocks which do make sense, you're unlikely to get much allotment. Excuse me. So, therefore, what people are doing is that they are not really taking a call on investing in a company. They think this is some kind of investment in a IPO process, as another fund manager put it, that so it is like a lottery that you are playing. So that's, IPOs are a strange animal as of now. So, when markets are not that good, then you can actually properly evaluate and invest in an IPO or not. I mean, as I was pointing out to someone who was talking about whether someone's parents won an allotment in the Infosys IPO, and I said, do you know that it was an undersubscribed IPO that actually devolved on the underwriters and eventually made a lot of money for those underwriters. But coming back to the cross-country bit, see, the PE of a stock is determined by three things. One is the cost of capital, which means the risk-free rate plus the risk premium in that particular geography. So, I mean, interest rates around the world differ. Then the other thing is the growth. So again, the growth rate in Korea and in India may be different. And the third thing is the return on equity or return on incremental capital, to be exact, those are the things that determine the PE trajectory. And India, unfortunately, never gives you a free ride. So in India, always, as you said, most MNCs trade at a much higher multiple, and which is why, in India, you cannot have even a dividend deal kind of strategy, because anything that pays enough dividend always trades at such a high premium that you, on the market price, you don't get much of a dividend deal. So, that's the way it has been.
Absolutely, Devina. We're a country of bright-minded, what is it, last count, I think 1.4, almost 1.4 billion, right? So, things don't come easy or cheap in India. Pleasure having you on the show this morning. Thanks for joining in, and we look forward to the next conversation. Well, speaking about, interesting trends in the Indian market, let's now focus on lab-grown diamonds. Is this a space that's set for big disruption? And if yes, what impact is it going to have on existing jewelry brands like Titan? What about the new incumbents or the new players coming into the market? Well, let's tell you what's the latest development first up. Trent has launched its new lab-grown diamond jewelry brand, Pom. This marks a significant entry into the sustainable luxury market. In fact, Kotak Institutional is quite optimistic on Pom. It says that this business has the potential to pioneer broad-based adoption of lab-grown diamond jewelry in India. So is this indeed going to be a big disruption? Yesterday, by the way, could be a coincidence. But anyway, as Trent was charging higher 8%, there was some pressure on Titan. We've got Avnish Roy, ED of Nuvama Institutional Equities, as well as Pooja Sheth Madhavan, founder and MD of Limelight Lab-Grown Diamonds with us. Lady and gentlemen, thanks very much for joining in. Pooja, so let's start with understanding the basics of the market and how things are stacking up right now. In all our conversation with most of the listed jewelry companies, we do talk about how they're experimenting with lab-grown and what impact that's having on their natural diamond sales, whether it's solitaires or studded jewelry. You tell us, how big is the market now? What are the growth numbers that lab-grown diamonds have tracked? And what is the expectation? What do you expect in the segment?
Yeah, thanks for having me. And so in terms of the global growth, I think lab-grown diamond, diamond as an industry, United States stands as a benchmark to understand, what happens to the diamond industry, because the largest consumption of diamonds has happened in the US. And if you see the current trend in the US, 50% of sales are now lab-growns in the US. The lab-grown diamond market is a global $15 billion market. It's captured close to 20% of the global gems and jewelry, market share. And even in India, we are seeing, a 15 to 20% year-on-year growth in lab-grown diamonds consumption, in lab-grown diamonds acceptance. So I do believe that the next biggest consumption potential that exists for lab-grown diamonds after the United States is most certainly India.
But Pooja, so to expand on that point, you're saying the growth in India is 15 to 20%. The question is this at all, I mean, coming at the expense of natural diamonds, or is this incrementally growing the market? They're catering to a very different market segment, right? But I think the question that the stock market is beginning to ask is that whether there will be some cannibalization because of changing customer behavior and preferences, at least at the mass affluent level.
Most certainly, it's a combination. At this point in time, whilst we are seeing incremental demand, so in India, the data suggests that only less than 5% of Indian women have actually been able to afford or wear diamonds. The balance 95% has continuously aspired to wear diamonds but never gotten hold of them. So there's a combination of the 5% also today that is, sort of procuring lab-grown diamonds, particularly in the larger size solitaires. Somebody that already has a 1 carat solitaire aspired for a 2 carat, a 3 carat, or a 5 carat is now sort of looking at lab-grown as an opportunity. Plus, new Indian consumers that have always aspired for diamonds but never gotten hands on them are also sort of, increasingly moving towards lab-grown diamond as a second.
I mean, even that 5%, less than 5, okay. I mean, but 5 is also maybe too high. But it's less than 5, as Pooja said. Pooja and Abneesh, great to have both of you here. Abneesh, come in on this. What could be the total addressable market for lab-grown diamonds? I mean, any way to put a number to it?
So in our view, this will expand the market given now 3-4 players are entering this space in the organized and definitely whatever trend does, we take it very seriously. We have had a buy on trend for a long time and we continue to maintain a buy. And definitely now Trend, Senco and Goldiam, etc. will expand the market. The issue with lab-grown diamond is last few years, because of so much of oversupply, the prices have crashed 70, 80, 90%. So customer has got a lot of doubt that, okay, this is cheap, but if I invest my money, what happens to it after 1 year? So I think price stability will be needed. Second is, if you see, Titan definitely offers buyback kind of a pricing to the diamond and studded customer, and of course to the gold. That gives a lot of trust factor. So my sense is it may not impact the core part of the marriage demand for Titan and other players. This will expand the market, but for Titan, some impact will be there on their daily wear in terms of the Mia, in terms of the Carat Lane, and in terms of some of those businesses, there will be some impact. But still, my sense is the price stability and the buyback, that will be needed. So my sense is this is more of a long haul. This will expand the market, but we are quite positive on Trend. I think for them, this could be one more new vertical over a longer time frame.
Is price stability in lab-grown diamonds, why is it important, Abneesh? I mean, if you're talking about sort of, casual wear and fast fashion and those segments, right? Doesn't it make it more attractive if prices come off very sharply?
No, Indian customer, if you see, even for a 10 rupee pack, he always thinks whether this is something which I need to buy. The issue in jewelry is Indian customer comes with a mindset that, okay, I'm buying it at say 100, and he has seen that last 5 years, the lab-grown diamond prices have come up by 70, 80, 90%. So that fear factor is there that, okay, can this further correct? So that leads to overhang. And that's why my sense is now with organized players like Trend entering, that will bring some level of comfort that, okay, this is an organized player. Plus, the oversupply needs to correct in the market. Huge oversupply is there in terms of the market. And that is an issue for the customer. He feels that, again, my money can get impacted over the next 1 year, 2 year time frame. Because it is not small, right? It is much cheaper than the studded real diamond, but still there is an allocation, and Indian customer always has that in the back of the mind.
Clear. Thanks, Abneesh, for that. Just hang on. Let's go back to Pooja. Hi, Pooja. Good morning. Good to see you in. Nigel on this side. So Abneesh mentioned about pricing a couple of times. I wanted a couple of basic details. What's the price difference currently between a lab-grown as well as the original diamond, so to call it, price difference? And also, is there price stability now? Because as Abneesh mentioned as well, the fear was in the last 1 year, suddenly the prices crashed 40, 50, 60, 70%. So pricing and price difference. Please go ahead.
Yeah, no, Lisa, a couple of things. One is that the price, fall that we speak about largely has been capped at 50%. Secondly, that has happened at the wholesale level and at the trade level, but not at the retail level. The retail level has seen price stability. I mean, Limelight as a retail brand, we have been existing in India for the last 5 years. We have 30 plus stores in the country, and we have seen retail prices constantly stabilize over the last 5 years. So what has happened is, and actually it has not been a combination of oversupply and less demand. It has in fact been rationalization of profits. So initially what happened is there were lesser players, lesser growers who were producing lab-grown diamonds in the market, and therefore naturally by the instincts of any industry, they priced the product at a very high price. So something that was selling at the costing at let's say $100 a carat was selling at $400 a carat. That as and when entrants started coming in, competition started coming in, that supernormal profits is what has resulted in the price decline. So the supernormal profits between 400 and 100 is now come down to a $120 per carat selling price in the wholesale market compared to $100 cost. So the intention was that the supernormal profits were reducing rather than there being a lack of demand and oversupply situation. Yes, in the last 3-4 months, there has been economic pressures on the US, which has sort of subdued the demand for diamonds in general. That's why we have seen a fall off in pricing of the natural diamonds also by 40% in the same breath. And we have seen, a decline in prices of lab-grown. But that's largely been rationalization of profits, which the trade was already prepared for. The retail level, there has always been stability. And going forward, we'll see further stability in the lab-grown diamond industry because the profits have now rationalized to a normal 20-50%.
All right, this is a discussion which I think we're only scratching the surface of, and we'll have both of you and others join in as well over the next many days and weeks. Abneesh and Pooja, thanks very much, both of you, for joining us and running us through your thoughts on what's happening here in the lab-grown diamond market and, of course, implications for listed companies like Trent, Titan and others. Time for a quick commercial break here. On the other side, we get on with our RBI policy coverage with a whole host of guests as we wait for the much-awaited RBI Governor address. Stay tuned. That's coming up. Just a quick preview of some of the faces that you will see coming up on the other side.
Hello and welcome to our special monetary policy coverage. We're going to be hearing from the Reserve Bank of India Governor very shortly. But before we do that, let us quickly take you through what our poll was suggesting, and that is a status quo on rates for the 10th consecutive time, because there's no real reason for the Reserve Bank of India to move just yet. But this is going to be a very interesting policy because it's probably the first monetary policy this year where at least a section of the markets is expecting a change in stance. In fact, 50% of the respondents to our poll said that the Reserve Bank of India could perhaps shift the stance from withdrawal of accommodation to neutral, although the others are just expecting some tinkering or if, not being left altogether. Apart from this, the other key things to watch out for is the growth forecast, where half the economists that we polled said that perhaps RBI may lower that 7.2% GDP growth forecast for the year by about 10 to 20 basis points, whereas the others are expecting it to be left unchanged. The CPI number, 4.5% for the current year, is widely expected to be left unchanged, although some are expecting a slight, again, 10 to 20 basis point downward revision because, the inflation print undershot what the RBI had factored in for the second quarter. So those are the big expectations going into the policy. But for more, nuances on what really to expect, we have a host of special guests who are joining us. For now, we have Kaushik Das from Deutsche Bank, chief economist there, with us now. Kaushik, quickly to begin with, what are you going into this policy expecting? What sort of a dovish tilt, if at all, could we perhaps see from the governor?
Hi, good morning. Actually, I wrote in my report on the preview that it will be a dovish status quo. So we are expecting rates to remain unchanged in this policy. There's a lot of debate whether the stance should be changed or not. We think that this is an opportune time for changing the stance because, the global rate cycle have changed. A lot of things are happening which would, kind of justify the RBI to change the stance if they want to. That will give them a lot of flexibility. But then, we know that, the 3 new members, non-RBI MPC members have joined in. So are they ready or they want to settle down before doing the change in stance? So this uncertainty is there, but this is a good time for changing the stance and indicating to the market that RBI probably would, kind of look at both growth and inflation and not just focus on inflation at this stage. Because what we've seen over the last few weeks, that the data that have come out from on the growth front, high frequency indicators have shown a slowdown, whether it is GST or whether it is corporate earnings, PMI, auto sales, a host of data, IIP or core infrastructure production. So I think at this stage, given that the global rate cycle have turned, RBI should change the stance to neutral. Whether they do it or not is something we need to wait for Governor Das to give us the direction. Growth, they have given 7.2% forecast. Bloomberg consensus estimates from professional forecasters are about 6.9. So it is possible that they could reduce it a little lower, or they could hold on till the December policy and wait for the July-September GDP data to come out before making up their mind. Inflation full-year growth forecast, I think remains unchanged at 4.5%. But as you mentioned, July-September inflation number would be revised down to 4.1 from the 4.4 that they had given. And the next 2 quarters, they'll probably, tinker a bit to keep the full-year forecast at 4.5. So nothing much change from GDP or inflation per se, but the tone and the guidance for the market, whether RBI will be ready to cut rates from December, that will be something which markets will be waiting to, hear from Governor Das.
Okay, thanks a lot for that, Kaushik. That's a fairly comprehensive wrap of what is expected. Lakshmi, what are you going with? Is there a likelihood of growth forecast being brought down and a stance changing? If that happens, what happens to yields? If there is a dovish tilt and if there isn't?
So hi, Lata, morning. If there is a dovish tilt, obviously markets will take it positively in the stride. And obviously, apart from the policy, the FTSE announcement of index inclusion also is a slight nudge. I won't say it's a massive nudge, but it's a slight nudge. So if it's a dovish tilt with a change of stance, certainly we will see yields going lower from the current levels. But if there were to be nothing, then there'll be a minor disappointment because either which ways we are looking at a very tight movement of range driven yield movements, given that very, very strong anchors in the form of foreign investor buying still continues to be there. And I think that's where the markets are in a mood right now. Any sort of positive surprise will definitely give some leg down to the yields from the current levels.
Leg down is what, 6.75?
Yeah, we are already at 6.79, so about 5 basis odd from the current levels. Eventually, Lata, we are seeing yields definitely recede lower because the anticipation of rate cut, maybe in the next policy or the one after that, will keep the yields anchored. So I think eventually, while the yields are headed lower, this is more a today's reaction.
Okay, fair point. Devang, you know, the buzz I got from the market is there is an outsized reaction on the downside if there is a change in stance to neutral or growth is brought down. But if nothing is changed, there won't be a bad reaction. That is, you're not going to 6.85 or anything. Is that your view? What would be yours?
Yeah, I would completely agree with that, Lata, because first of all, I think if you look at the last few trading sessions, traders have significantly lightened their positions, and market is probably going with the status quo on largely on monetary policy stance as well as on the rates. So a surprise on a stance change definitely will take yields lower. And without any changes, I think probably in the markets would, as Lakshmi highlighted, probably market would give a small negative reaction of 2-3 basis, but otherwise market should trade in a narrow range. With our perspective also is that probably there's a lot of Fed data which is going to get released. We have the minutes today, we have the CPI, and UST is actually sold off by 40 basis in the last 7 to 8 sessions. So our view is that yes, you should probably go long into the policy.
Okay. Just a word, Kaushik, very quickly. I don't know if we have Indranil with us. So very quickly, do you think there is some LCR announcement possible? The liquidity coverage ratio, because that is a very important announcement for the bond markets as well.
I think RBI will take the opportunity of this policy to make some announcement on the regulatory front also, because October is an important policy. It will come out with the NPR report as well. So I think there will be some announcement on LCR guidelines, and people are expecting whether it will be staggered more than what they have already mentioned and getting a little bit of breather for the banking system to comply with the rules that they have suggested. So yes, in short, we would expect some announcement on LCR in this policy.
Okay. We have Indranil with us? Okay. All right. I think we'll get back to it. Okay. Indranil, what's your sense? Good morning. Thanks for joining. What's your sense? Can there be a dovish tilt? Would you advise your treasury to go long into the policy?
Whether the treasury goes long into the policy or not also depends on a lot of other things today than only the monetary policy. For example, the news of the inclusion in another bond index. So the demand side is much higher than the supply side at this point in time. Coming back to the policy, I think, yes, to a certain extent, the growth is slowing down. But I think that is anyways the intention of the policy in terms of preventing a frothy nature of the growth. And growth is slowing down. Therefore, at the margin, we don't see a very significant crash landing sort of a scenario. On the other hand, we still have some tail risks in terms of the inflation, which probably will prevent, along with the fact that the crude oil prices again has bounced up. The global commodity prices also are relatively on the higher side, will probably lead to the RBI to hold back any signaling even on a dovish tilt at this point in time. So I think like previous policies, they will be well balanced.
May I interrupt you?
Will be...
Yeah, may I interrupt you? Since you are the banker here, actually involved in the team that, or advising the team that lends out loans, is there any point in a rate cut now or in December when deposit rates are still not finished peaking off, or so it seems? Wouldn't it be a wasted cut? What's your sense? Have deposit rates peaked?
No, so deposit rates probably have peaked, but the point that needs to be very clearly understood is that if there is a rate cut and wherever it comes, it will be very difficult for the banking sector to actually reduce deposit rates immediately, because banks are struggling with liquidity, and I think Kaushik was talking about the LCR policy. If the LCR policy actually comes in the way indicated in the draft, then obviously all banks will have to sort of raising deposits as well as SLR and HQLA securities. So from that perspective, it is very difficult to see deposit rate falls, whereas on the EBLR side, we should have some reduction and pass-through that will automatically happen. That I think is the situation at this point in time. Now, the whole hope that rate cuts will propel growth may not actually happen, because if the cost of the funds of the banking sector don't come down, then possibly you will not see any benefit in terms of the MCLRs and the lending side of the project loan perspective. So that I think is the limited point that I would want to make.
No, that's a very important point. It's not limited at all, because the market normally thinks that when there is a rate cut, there is possibly some positivity for the bank Nifty because there are mark-to-market gains. But this time it's not going to be, especially after the external benchmark issue. We are going to see loans actually falling because they are linked to the repo rate. But the cost of the money is not linked to the RBI's rate, and that stays high. In fact, it may even rise a bit, and therefore a rate cut or signs of dovishness could be Bank Nifty negative. But let me quickly add that this negativity is priced in, and we had I think the BNP Paribas analyst explaining in great detail that the loss to bank earnings is only up to about 3%. So there's about a 3% loss to some banks' EPS if there is a rate cut. So it's not an outsized loss, but they are not going to gain from a rate cut. They're going to suffer from a rate cut. Lakshmi, is there a structural bull run in bonds? Of course, the FTSE inclusion is very small. I believe it's just about 4.5 billion that's coming in, and that too from next September. But it paves the way probably for the Bloomberg aggregate inclusion. So you think there is a structural bullishness here, Lakshmi?
So Lata, if you look at the demand and supply dynamics, clearly, the skew currently is favor of demand outstripping the supply. Fiscal deficit is under control. The rupee is pretty range bound. FX is at an all-time high. So you have the entire Triveni Sangam, which are, kind of confluencing to ensure that the yields come down. So therefore, I don't know whether you call it structural or otherwise, but looks like world over central bankers have made a beeline for rate cuts. So sentimentally positive across the globe is the buying bond syndrome. And even in India, if you see 1.22 trillion, rupees or $14 billion pumped in by FPIs in this calendar year alone, and we still have a couple of months more to go. So looks like the yields are headed lower, and as Devang rightly alluded to, going long duration in this market, especially when a relative risk-adjusted return clearly is in the favor of fixed income, seems to be the way ahead. And yes, the rate cuts have still not started happening. Contrary to the US, where they are discounting aggressive rate cuts, every asset class is discounting aggressive rate cuts. That's not really the case in India for now.
Yeah, we're not talking about rate cuts just yet. In fact, 70% of the economists that we polled said perhaps the window will only open in December. But Indranil, do you think there could be a possible rewording of the communication itself to indicate a greater balance between inflation and also growth, given the mixed indicators we're getting there?
So my sense is that they will probably retain the inflation forecast for now. While there can be a bit of a down rating in terms of the growth numbers to say about a 7%. But in the current scenario where the rest of the world is so slowing, even a 7% growth is not bad. And we are also possibly likely to see, given the good agricultural production, likely to see a reorientation in the growth pattern more towards the rural side from the urban side, which urban side anyways, in my opinion, was tending to get a bit frothy. And that possibly is a situation that the RBI would also possibly like from the growth inflation balance they wanted to reach. Plus, I think they had been talking about the high CD ratio. Yes, the CD ratio has been coming down. But my sense is that they would possibly want to see the CD ratio come in the 75-76% zone before they breathe comfort in terms of the financial sector risks. So to say. So yes, I think therefore to a certain extent they can, and given the fact that the overall sort of financial conditions are still quite easy, with liquidity probably quite in a good shape at this point in time, and expected government spending could actually continue to boost the flows in terms of the rupee liquidity. There should not be an immediate hurry from a Reserve Bank of India to signal a dovish policy stance.
Okay, Devang, even if there is no change in stance in this policy, because there's only a section of the markets that is expecting that, is it going to be taken negatively at all, or the markets are going to move on to the next cues?
So we believe that, as I highlighted before, I think positioning-wise, markets have gone probably neutralish. We believe at this point of time, as highlighted by all the panelists, there is a good probability of RBI to look at stance change. But even if it doesn't come, our expectation is, yes, probably you can see some bit of disappointment in the rise in yield of around 2-3 basis. But directionally, I think probably the positive demand supply dynamics, the overall macro theme where core inflation continues to surprise us on downside, and the overall CPI trend looks in the 4%, 4.5% gap, we believe that rates have directionally headed lower.
Right, we're just moments away from the governor's speech. So thank you, Lakshmi, Devang, Indranil and Kaushik for joining us here and helping us understand, what we should expect from the governor just moments from now. For our viewers just joining in, the expectation is not of a rate cut, but some in the market are expecting a shift in stance, which may or may not come. But a dovish tilt is what some of our panelists here were talking about. Although some, like Indranil, believe the tone may be absolutely even, no giving away when the policy may pivot. Watch out for the growth forecast as well at 7.2% at the moment. Half the respondents to our poll said it could be revised downwards, but even at about 7% or so, it's not a bad GDP number we're looking at. As far as inflation is concerned, there could be some tinkering in the quarterly forecast, given that in the second quarter, inflation has undershot what RBI was expecting. And, in the coming months, it is expected, as the base effect wears off, to come in around 5% or so. We have the governor. Take a look.
This is the 51st meeting of the Monetary Policy Committee, that is the MPC, and this is how it goes. The flexible inflation targeting framework has completed 8 years since its introduction in 2016. This is a major structural reforms of 21st century India. It stands out for its committee approach to decision making, transparency of policy-making process and communication, accountability hinging upon quantitatively defined inflation target, and operational independence. Over the years, the framework has matured across various interest rate cycles and monetary policy stances. When I look back, I can say with confidence that the flexible inflation targeting has served us well over the years and has proved its mettle. It brought about an era of price stability in the pre-COVID-19 period, with inflation averaging around the target rate of 4%. Thereafter, despite continuing global turmoil from multiple sources in the last 4 years or so, the flexibility embedded in the flexible inflation targeting framework has helped us to effectively address these unprecedented challenges while supporting growth. Monetary policy in India was able to respond to the economic slowdown decisively and swiftly in the wake of the COVID-19 pandemic, and again preemptively during the buildup of inflationary pressures after the war began in Ukraine in early 2022. The prevailing well-balanced growth inflation dynamics is indeed a testimony to the success of this monetary policy framework. Let me now turn to the decisions and deliberations of the Monetary Policy Committee. The Monetary Policy Committee met on, and this time, as you would be aware, this time we have 3 new external members in the MPC. The Monetary Policy Committee with 3 new external members met on 7th, 8th and 9th October. And after assessing the evolving macroeconomic and financial conditions and the outlook, the MPC decided by a majority of 5 out of 6 members to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is the SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate and the bank rate, they stand at 6.75%. Further, the MPC decided unanimously to change the stance that is the stance of the monetary policy, to neutral, and also decided to, let me read it again, the MPC decided unanimously to change the stance to neutral and to remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC noted that currently the macroeconomic parameters of inflation and growth are well balanced. Headline inflation is on a downward trajectory, though its pace has been slow and uneven. Going forward, the moderation in headline inflation is expected to reverse in September and likely to remain elevated in the near term due to adverse base effects, among other factors. Food inflation pressures could see some easing later in the financial year on the back of strong Kharif sowing, adequate buffer stocks, and good soil moisture conditions, which are conducive for Rabi sowing. Adverse weather events continue to pose contingent risks to food inflation. Core inflation, on the other hand, appears to have bottomed out. Fuel component of the CPI remains in contraction. Domestic growth has sustained its momentum with private consumption and investment growing in tandem. Resilient growth gives us the space to focus on inflation so as to enable its durable descent to the 4% target. In these circumstances, the MPC decided to remain watchful of the evolving outlook in the coming months. Keeping in view the prevailing inflation and growth conditions and the outlook, the MPC considered it appropriate to change the stance to neutral and to remain unambiguously focused on a durable alignment of inflation with the target, while of course supporting growth. I would now turn to an assessment of the growth and inflation situation. First, let me talk in brief about the global growth conditions. The global economy has remained resilient since the last meeting of the MPC in August. Although downside risks from increasingly intense geopolitical conflicts, geoeconomic fragmentation, financial market volatility, and elevated public debt continue to play out. Manufacturing is showing signs of slowdown while services activity is holding up. World trade is exhibiting improvement. Inflation is softening, supported by lower energy prices. Growing divergence in inflation growth dynamics across countries has resulted in varying monetary policy responses. Let me now turn to domestic growth. Real GDP grew by 6.7% in the first quarter of this financial year, that is 24-25. And this was led by a revival in private consumption and improvement in investment. The share of investment in GDP reached its highest level since 2012-13. Government expenditure, on the other hand, contracted during the first quarter. On the supply side, gross value added, that is GVA, expanded by 6.8%, surpassing the GDP growth, aided by strong industrial and services sector activities. High-frequency indicators available so far suggest that domestic economic activity continues to be steady. The main components from the supply side, that is agriculture, manufacturing, and services, they remain resilient. Agricultural growth has been supported by above normal southwest monsoon rainfall and better Kharif sowing. Higher reservoir levels with good moisture conditions of soil augur well for the ensuing Rabi crop. Manufacturing activity is gaining on the back of improving domestic demand, lower input costs, and supportive policy environment from the government. 8 core industries output fell by 1.8% in August on a high base. Excess rainfall also dampened the production in certain sectors such as electricity, coal and cement in August. The Purchasing Managers Index, that is PMI for manufacturing at 56.5 for September remained elevated. The services sector continues to grow at a strong pace. PMI services at 57.7 in September indicates robust expansion. On the demand side, rural demand is trending upwards while urban demand continues to hold firm. Government consumption is improving. Investment activity remains buoyant with government capex rebounding from a contraction observed in the first quarter of this year. Private investment also continues to gain steam on the back of expansion in non-food bank credit, higher capacity utilization and rising investment intentions. On the external front, services exports is supporting overall growth. Looking ahead, India's growth story remains intact as its fundamental drivers, namely consumption and investment demand, are gaining momentum. Prospects of private consumption, the mainstay of aggregate demand, look bright on the back of improved agricultural outlook and rural demand. Sustained buoyancy in services would also support urban demand. Government expenditure of the centre and the states is expected to pick up pace in line with the budget estimates. Investment activity would benefit from consumer and business optimism, government's continued thrust on capex, and healthy balance sheets of banks and corporates. Taking all these factors into consideration, real GDP growth for 24-25 is projected at 7.2%, with Q2 at 7%, Q3 at 7.4%, and Q4 7.4%. Real GDP growth for Q1 of next financial year, that is 25-26, is projected at 7.3%. The risks are evenly balanced. I would now like to turn to inflation. Now, as anticipated, headline inflation softened significantly in July and August, with base effect playing a major role in the month of July. Food inflation experienced a certain degree of correction during these 2 months. Considerable divergence, however, was observed within the food subgroups. Now, whatever I am saying, I have given a lot of data in the footnote of my statement, which as usual will be uploaded in the RBI website immediately after my statement is, immediately after I complete my statement. For example, I just now said that considerable divergence, however, was observed within the food subgroups. So this is backed up by the data which I have given in the footnotes. And in fact, all the statements that I am making are backed up by supportive data there in the footnotes. So those of you who are interested may like to have a look at them after it is uploaded. Now, deflation in fuel group deepened on softening electricity and LPG prices. Core inflation, on the other hand, edged up in July and August. The CPI print for the month of September is expected to see a big jump due to unfavorable base effects and pick up in food price momentum. And this would be caused by the lingering effects of a shortfall in production of onion, potato and chana dal, that is gram, in 2023-24, among other factors. The headline inflation trajectory, however, is projected to sequentially moderate in Q4 of the current financial year due to good kharif harvest, ample buffer stocks of cereals, and a likely good crop in the ensuing Rabi season. Unexpected weather events and worsening geopolitical conflicts continue as major upside risks to inflation. International crude prices have become volatile in the month of October, that is in the current month. The recent uptick in food and metal prices, and this is very important, the recent uptick in food and metal prices as seen in the FAO, that is Food and Agricultural Organization, and the World Bank price indices for September, if sustained, can add to the upside risks to CPI inflation. Taking into account all these factors, CPI inflation for 2024-25, that is for the current year, is projected at 4.5%, with Q2 at 4.1%, Q3 at 4.8%, and Q4 at 4.2%. CPI inflation for the first quarter, that is Q1 of next financial year, that is 2025-26, is projected at 4.3%. The risks are evenly balanced. Now, I have summarized our assessment of the domestic growth and the inflation conditions and the outlook as per our assessment. Now, what do this raises the question, what do these inflation and growth conditions mean for monetary policy? The developments since the last meeting of MPC in August indicate further progress towards realizing a durable disinflation towards the target. Despite the near-term upsides to inflation from food prices, the evolving domestic price situation signals moderation in headline inflation thereafter. The agricultural crop outlook is turning out to be favorable, with improving prospects of Kharif and Rabi output. These factors could lead to an easing of food inflation pressures, but this optimism is subject to weather-related shocks, if any. Core inflation is likely to remain broadly contained on continuing transmission of past monetary policy actions, unless, of course, there are surprises in global commodity prices. The prevailing and expected inflation growth balance, please mark my words, the prevailing and the expected inflation growth balance have created congenial conditions for a change in monetary policy stance to neutral. Even as there is greater confidence in navigating the last mile of disinflation, significant risks, I repeat, significant risks to inflation from adverse weather events, accentuating geopolitical conflicts, and the very recent increase in certain commodity prices continue to stare at us. The adverse impact of these risks cannot be undermined, cannot be underestimated. It's with a lot of effort that the inflation horse has been brought to the stable, that is closer to the target within the tolerance band compared to its highest or heightened levels 2 years ago. We have to be very careful about opening the gate, as the horse may simply bolt again. We must keep the horse in tight leash so that we do not lose control. Going forward, we need to closely monitor the evolving conditions for further confirmation of the disinflationary impulses. I would now like to turn to the liquidity and financial market conditions. System liquidity remained in surplus during August and September, and also in early October, with a pickup in government spending and decline in currency in circulation. Liquidity conditions, however, had turned into deficit for a brief period during the latter half of September, with the buildup of government cash balances on account of tax-related outflows. In sync with the shifting liquidity conditions, the Reserve Bank proactively conducted two-way operations to ensure alignment of interbank overnight rate with the policy repo rate. Across the term money market segments, the yields on 3-month treasury bills, that is T-bills, and commercial papers issued by non-banking financial companies, that is NBFCs, eased, while that on certificates of deposits firmed up marginally. The 10-year G-Sec yield softened in August-September on global and domestic cues, including policy pivot in the United States and also in some major economies. And also, these are not the only factors, but the yields in August-September, I'm talking about the 10-year G-Sec yields, they softened somewhat in August and September due to multiple factors, which would include pivot in the monetary policy of the US and some major economies, improved global investor sentiment, benign domestic inflation, and accelerated fiscal consolidation. The term premium, that is 10-year G-Sec yield minus 3-month T-bills yield, has remained stable in the recent few months. Transmission to the credit market has been satisfactory. Moving forward, the Reserve Bank will continue to be nimble and flexible in its liquidity management operations. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner. During the current financial year, that is up to 8th of October, that is till yesterday, the exchange rate of the Indian rupee has remained largely range-bound. The Indian rupee also continued to be the least volatile among peer EME currencies. This was so even during the high volatile episode following the unwinding of the yen carry trade in early August this year. The lower volatility of the Indian rupee reflects India's strong macroeconomic fundamentals and improved external sector outlook. I would now turn to financial stability. The health parameters of banks and NBFCs in India continue to be strong. There has been some recent commentary on the likelihood of stress buildup in a few unsecured loan segments like loans for consumption purposes, microfinance loans, and credit card outstandings. The Reserve Bank is closely monitoring the incoming information and will take measures as may be considered necessary. Banks and NBFCs on their part need to carefully assess their individual exposures in these areas, both in terms of size and quality. Their underwriting standards and post-sanction monitoring have to be robust. Continued attention also needs to be given to potential risks from inoperative deposit accounts, cybersecurity landscape, mule accounts, and a few other factors which we have been stressing and highlighting time and again in the public domain as well as in our interaction with the banks and NBFCs. Now, overall, I would again like to stress that our banking and the NBFC sector, that is the financial sector, remains healthy, resilient, and stable. NBFCs in particular have registered an impressive growth over the last few years. This has resulted in more credit flow to remote and underserved segments, bolstering financial inclusion. While the overall NBFC sector remains healthy, let me re-emphasize, while the overall NBFC sector remains healthy, I have a few messages to certain outliers. First, it is observed that some NBFCs are aggressively pursuing growth without building up sustainable business practices and risk management frameworks, which should be commensurate with the scale and complexity of their portfolio. An imprudent growth at any cost approach would be counterproductive for their own health. Second, driven by significant accretion to their capital from both domestic and overseas sources, and sometimes under pressure from their investors, some NBFCs, including microfinance institutions and housing finance companies, are chasing excessive returns on their equity. While such pursuits are in the domain of the boards and managements of NBFCs, concerns arise when interest rates charged by them become usurious and get combined with unreasonably high processing fees and frivolous penalties. These practices are sometimes further accentuated by what appears to be a push effect as business targets drive retail credit growth rather than its actual demand. I'm not generalizing it for the whole NBFC sector. There are certain NBFCs where it is happening. Bilaterally, we are engaged with them, but I think this is a message which it's important not only for these outliers to keep in mind, but I think this should act as a guidance for the entire sector. Now, the consequent high cost, I was talking about the push effect, that is business targets driving retail growth rather than its actual demand. In that context, I would like to say that the consequent high cost and high indebtedness could pose financial stability risks if not addressed by these NBFCs in time. Third, NBFCs may review their prevailing compensation practices, variable pay and incentive structures, some of which appear to be purely target-driven in certain NBFCs. Such practices may result in adverse work culture and poor customer service. To sum up, it is important that NBFCs, including MFIs and housing finance companies, follow sustainable business goals, a compliance-first culture, a strong risk management framework, a strict adherence to fair practices code, and a sincere approach to customer grievances. The Reserve Bank is closely monitoring these areas and will not hesitate to take appropriate action if necessary. Self-correction by NBFCs would, however, be the desired option. Coming to external sector, India's current account deficit, that is CAD, widened to 1.1% of GDP in the first quarter of this financial year, that is 24-25, and this was on account of higher trade deficit. Buoyancy in services exports and strong remittance receipts are expected to keep the current account deficit within the sustainable level. On the external financing side, foreign portfolio investment, that is FPI flows, have seen a turnaround from the net outflows of $4.2 billion in April and May this year. They have turned from net outflows. In April and May, we had net outflow of $4.2 billion. Now they have now turned to net inflows of $19.2 billion during June to October, and this is the figure till 7th of October. Foreign direct investment, that is FDI flows, remain strong in 24-25, as both gross and net FDI flows have improved in April and July. While external commercial borrowings moderated, non-resident deposits recorded higher net inflows compared to last year. India's foreign exchange reserves have already crossed a new milestone of $700 billion. Overall, India's external sector remains resilient as key external sector vulnerability indicators continue to improve. And when I say key external sector vulnerabilities continue to improve, I have backed it up by the data in the footnote of the statement. On the whole, we remain confident of meeting our external financing requirements comfortably. I shall now announce certain additional measures. The first relates to responsible lending conduct, levy of foreclosure charges, and or prepayment penalties on loans. The Reserve Bank has taken several measures over the years to safeguard consumer interest. As part of these measures, banks and NBFCs are not permitted to levy foreclosure charges or prepayment penalties on any floating rate term loan sanctioned to individual borrowers for non-business purposes. That is, for purposes other than business. It is now proposed to broaden the scope of these guidelines to include loans to micro and small enterprises, that is MSEs. A draft circular in this regard shall be issued for public consultation. The second announcement relates to discussion paper on capital raising avenues for primary urban cooperative banks, that is for UCBs. The Reserve Bank has undertaken several initiatives in recent years to strengthen the UCB sector. Such initiatives include issuance of regulatory guidelines in 2022 for issue and regulation of share capital and securities by the urban cooperative banks. To provide more flexibility and avenues to the UCBs, that is urban cooperative banks, to raise capital, a discussion paper on capital raising avenues for UCBs will be issued for feedback and suggestions from stakeholders. The third announcement relates to creation of Reserve Bank Climate Risk Information